So this is a very aggressive strategy where you're basically leveraging up, if you use the full maximum, up into about 7 to 8 times your money. So you do control a lot, which can be very good if you're correct in the trade, but could also be very bad if you are incorrect in the trade. I ran approximately 50 million in the strategy. Typically in this strategy, other than bear market cycles, you can see returns anywhere from low 20s to in excess of 40%. But calling someone to tell them you've lost almost half your portfolio not an easy call. And then you have to kind of sense what the client he's going to say after that, because what are you going to say? All you can say is you're sorry.
The financial industry is ruthless, both in its competitions and the stakes with which you play. And while many people are excited to talk about their wins and their victories, it is a treasure to have someone that is not only willing to talk about their wins, their failures as well, and to pass on that experience and wisdom, which is why today I am happy to share this experience with you, to be able to talk to Matt about his decades of experience in the markets and what led to him having to take a hiatus. I hope you learn a lot from this podcast. And without further ado, I'll leave you to enjoy Matt's journey. Can you kind of walk us through what your background was in finance, kind of how you got into it, and who you worked for, and what your area of expertise was?
Sure. So my quest to work on Wall Street started back in the 80s when I chose to go to a college up east by the name of Adelphi University that offered a degree which was in banking and money management. And that's how I originally got started. And then when I graduated, obviously I got opportunity to work on Wall Street, initially with a smaller to medium-sized firm by the name of Gruntle. Gruntle was my first firm where I kind of learned about the business and everything. Um, it was a stepping stone. That's what I was hoping to use it for, to get to a larger, more recognizable firm. After working at Gruntle for just over a year, I did get a new opportunity to work at Lehman Brothers. And that was probably one of my favorite firms that I worked at over all the years I was on Wall Street. Um, Lehman taught us a lot about sales. It was all about sales at Lehman. You had some of the best products that were on the street, and it made it fairly easy at that time to gain clients because there was still a prestige or panache to be recognized working for Lehman Brothers. Um, my career at Lehman Brothers was limited, though, because they chose to go a different direction and they chose no longer to do retail at that time. And I made it was Shearson Lehman Brothers was the full company. So I did go over to the mother side being Shearson, worked at Shearson for about 5 years. That's where I started what I really enjoyed my passion for, which was options. So that was probably about 5 or 6 years into my 30-year career. I find that options, you do need to be very educated and versed with them. They are a very aggressive instrument to use if you're going to be investing in the market. You want to be seasoned if you're using options, unless you're just doing simple strategies like covered call strategies or a small dollar amount in a long or a short put. So while I was at Salomon Brothers, the opportunity came to work with a specific client that had called me and had asked if I could do naked options. And I wasn't even aware of what naked options were at the time. Um, but I went to my manager and asked him about it, and he said, yes, we do leverage naked options. So this is a very aggressive strategy where you're basically leveraging up, if you use the full maximum, up into about 7 to 8 times your money. So you do control a lot, which can be very good if you're correct in the trade, but could also be very bad if you are incorrect in the trade.
Yeah.
So he liked to play what are called strangles. And a strangle basically is a top and a bottom to your strategy, your trade that you are doing, and you want the market to stay within your strangle that you have created on the market. So you want low to modest volatility during this period if you're doing this kind of strategy. When the strategy goes outside of the current strangle that you have to adjust your strangle appropriately. Typically, you will move out and higher or lower, higher being the top end, which would be your call side of the strategy, or the bottom end, which would be your put side of the strategy. And I'm sorry if I'm going a little bit fast, guys, and I'm also assuming some people have some knowledge of options, because if you have no knowledge of options, this is going to be pretty Greek to you.
Yeah.
But as long as you have some basic option experience, then I think this can be valuable for you. So this is a strategy I did produce for over 20 years. It was very rewarding for me and my clients over all those years. Average return was north of 20% a year. I did that for a couple of decades. But what everyone needs to be aware of and be careful of is there are times, especially in the market, when a black swan can appear. And these are very, very high volatility periods. Usually they're very short-lived, but you can see market swings in excess of 20% during these periods. If you were doing the strategy that I had mentioned, that is what I call a tsunami for your strategy during that period. This is a huge tidal wave that's going to make you wrong on one side of your trade. Because you have a strangle, you have a top and a bottom. You can never be wrong on both sides at the same time. But the side that you're wrong on is going to far exceed whatever small gain you're making on the opposite side. So during a period where the market is volatile enough to be a 20% swing in a 30-day or less range, you might find yourself underwater doing this strategy by as much as 30-40%, could be even more than that during that period, because you are naked and you are leveraged. So the expansion of money during that time, and in this case, it's going against you, not for you, can be nerve-wracking. Let's say if you're not experienced, you're going to quickly find some experience quick, or you're going to be in big trouble with some big losses. So if you can survive a 20% move in the market once, you pretty much have your seasoned, you become a seasoned trader at that point, because then you learned how to handle the market under the roughest period that they can have. Now, with that said, the experience I had when COVID came was unlike anything I had experienced before. I had been through many rough periods in the market, such as 9/11, such as the tech bubble, such as the housing bubble. These were all very tough periods in the market, but they happened over time. So because they happened over time, the volatility was measured over a length of time. What we had with the COVID situation was just a pure precipitous drop that the market had never seen that kind of drop in that short of a period. We actually had a 20% recession within 2 weeks of the market having the initial COVID panic that set in. So the one thing that I always suggest to people is try to stick to your disciplines. During the very volatile times, that can be the very most important, because if you don't, you can find yourself losing a lot of money. I will say that I didn't do exactly what I had hoped to do during this volatile period. I knew the market was dropping rapidly, but I knew it wasn't going to be sustainable or that the market wouldn't recover. The problem sometimes is you don't have enough money or time to stay involved. And if you don't have that deep, deep pockets, then you have to be careful because you'll get pulled out of the strategy by margin and you will not have the chance to come back and the capital will be lost. At least that capital will be lost. You would have to come up with a new capital in order to come back in.
I do. I just want to jump in there real quick. I don't know if you mentioned this, but what kind of duration did you have on these contracts?
Okay, so typically the duration is good question, is very short term. I'm typically playing 3 to 5 week intervals. So they're
Okay.
pretty short term. That was until they came up with weekly expirations on the exchange. So sometimes you might do as short as 2 weeks. If you did anything shorter than that, because they now have, as you know, multi-daily options available on indexes, you just have to play that much closer to the vest to get a return that you're taking on what I deem to be unneeded risk. There's enough risk in the strategy then to play shorter durations and get even a higher risk at that point. Typically, the market won't have a 20% correction in a 30-day window. That only comes about I would say every 5 to 7 years. The typical downturn in the market takes more like 3 months to occur if you're going to get a 20% correction. You can handle a 20% correction in a 30-day window pretty nicely with the strategy. The 30-day drop in or the 20% drop in 30 days is the one that I call the tsunami. And it will take you probably 3 to 6 months to make a full recovery again under that situation. Those are the extreme. That's when you look at the vol in the market and it's gone off the chart during those periods.
So so how much money were you managing when you were operating this?
So
I guess that, and then how large were the position sizes?
okay, so I ran approximately 50 million in the strategy, but leveraged up to not quite, but as close to 10%. So it was like trading. I was handling option trades as large as 1,000 contracts naked.
Okay.
So
Okay.
if you think about that,
Yeah.
it's you also, when you deal with that kind of size, you have to deal with liquidity because even though the indexes are quite liquid, there's only so many takers out there on the other side willing to take on that trade. So you're already moving the market against yourself as you're executing.
Yeah.
So was this all index or did you do individual names as
Oh,
well?
you'd be insane to do this on an individual equity because you could walk in any given day and a equity could be down 40%. That's not, I mean, it's unusual, but that's not that unheard of. Those do happen in the market with certain stocks, probably every year. So you just don't know. The volatility is too high to do it on an individual equity, I find.
No, yeah,
Yeah.
absolutely. Looking at earnings season this quarter, a couple
And
of the
yeah,
high valuation
NVIDIA
tech stocks. Yeah, I haven't checked
got
Nvidia
hammered.
yet. They did pretty good today.
Did they recover today or they got hit again?
Let's see. I saw a
They
positive
They're
reported.
headline. Oh, they're up 10% after hours, it looks
Yeah, they
like.
reported today. So yeah.
yeah.
Oh
Wait,
yeah.
so
Yeah, I was just going to say, I just noticed that, a few of the growth tech stocks I follow, it's not very many. I'm more of a value guy, but the few that I do follow after post earnings are down like 20+%
Yeah.
in a day. It's like, oh my God, this is why I don't go in this market too often.
Yeah, it's very volatile, certain segments of the market, as we all know.
yeah.
What other
Absolutely.
kind of questions you guys have for me?
Yeah, so I wanted to kind of also talk about, and there's not a lot of people that had the insight. I do want to talk about your experience with processing that. Um what was the first major downturn you had? Would that have been the dot-com bubble for you?
That probably would have been, yeah, that would have been, there was one smaller wave called the Asian contagion, where there was a currency devaluation based on what was going on in Russia during that time. You had a big spike in oil. That one was a minor wave. I think that was like a 10%, 12% correction, but pretty quickly in a short period of time. So that kind of gave me the experience to handle the dot-com bubble when it ultimately came.
Okay. So when that first happened though, I mean, did you have a tutor? Did you have someone that you shadowed under when you were learning this
That
option
was
strategy?
my mentor was my client. My client introduced it to me. So
Okay.
I was learning as it took me to really get a good grasp of it about at least a year. You need to play
Okay.
around on paper for a while, for a length of time to get comfortable with it. Um, After just executing trades for him for about a year, I could finally interject and say, his name was Vinny, and I would say, "Hey, Vinny, why are we doing this? We're setting ourselves up for a potential negative trade, and our risk is higher." And then he'd look at it closer and he'd say, "Oh, you're right." And so once I could start to really help him help himself, that's when I finally got the grasp of the strategy.
That's a good
Yeah, I
that's a
feel
good way
like you
to
do
that's a
that
good
for
way to
me,
look at it.
Josh.
Yeah.
I'm more of a research analyst, came up through that route on
Sure.
equities and fixed income, and Josh got me into more tactical trading. I always had more of a long duration trade, and
Yep.
I'll send them charts and whatever, and say, "Hey, am I looking at this right?" Or he'll run it through, correct it, or say it's a good trade, and potentially put his own money in it too. So
Yeah.
Sure.
it's definitely a learning curve.
So how much technical analysis are you're probably not hardly doing anything. You're probably just running fully off of the implied volatility built into the stock, and then you're
Sure.
checking. Yeah. So it's just basically all off the option mechanics that you're watching then when you're running
Yeah,
something
a
like
lot of it is also by gut. You've got to have a strong gut and
that.
anticipation of historical things that happen because everyone, when they see the market drop 20%, is ready to, run. That's usually not the time to do it. It's already the damage is probably 90% done at that point, and you're very close to a bottom. And that's where it really tests you, and you've got to hang in during those tough periods when you know a bounce should be coming, but it doesn't show its face for a little while.
So when you're in those periods of taking that loss, how do you have what do you have some sort of methodology that you would go through to keep your mental intact? Because just with a strategy like that, it's so easy to screw it up. Like,
It can be
yeah,
easy to screw it up. You do
yeah.
always need maybe someone to bounce ideas off, because sometimes you will find yourself um, not looking at the whole picture because you're stuck on the wrong side of a trade, and that's
Mhm.
easy to do. And then we just basically talk to ourselves why. But you really sometimes just have to swallow your pride and take that loss and move on.
Right.
How
Yeah.
long do you usually wait before you cut your losses in a situation like that?
Usually with this strategy, the goal is not to there's only rare times you need to cut your loss. Okay, those are only going to be if you can catch it early during extreme volatility. Okay, if you can catch one side, and then if you chose to, you could start to play spreads instead of strangles, and then you could capture the volatility on the other side. But that's a whole nother discussion. um
Butterfly. Okay.
did I answer that how you wanted it, or did I answer it
No,
completely as well?
yeah, yeah.
Yeah, yeah, yeah. No, I think you did. No, I think you did.
Just, kind
What
of
a
working through risk management there.
Yeah, dude, I have a solid rule when I'm trading. If I feel like something's getting away from me, I feel like I've lost the plot on something or the narrative, just cut it all, reset.
Yeah.
Yeah, just quickly, just emotionless. You have
Oh,
to.
I know what I
Yeah,
didn't get to finish. I'm sorry, guys.
you're good.
Typically, instead of cutting the loss, you will maneuver the option strikes. So what you will do is go further out in duration. You'll pick up 30 days longer in duration. Let's say the market's already corrected 10, 15%, something like that. The actual market level is on your strike, or even you could be slightly underwater at that time. So what you'll do is you'll pick up your current option, go in duration 30 days longer, and move as deep as you can get in that trade for even money. So what you're trying to do, the option trade might be against you, where it's expanded to $25. You will then drop down as far as you can 30 days further and pick up $25. It may not give you the comfort and the distance that you would like, but since you're already 75% through a correction, a full correction of 20 at 15%, you do better to wait for the bounce and do the maneuver one more time if becomes necessary. And that will have moved you out approximately 60 days under a higher duress market. And then you'll just have to wait for the recovery and play calls on the top end while you're waiting for your bottom end to come back in line.
Okay. No, that's good input. That's great input. I also want to go back to the COVID thing, because I think the thing that I was trying to get at, or not COVID, I'm sorry, the dot-com bubble, when you first came encountered that, it looks like you had some experience you picked up from the Asian contagion, as you mentioned, but then I'm just trying to think of your mindset where you're managing this money. You're probably surrounded by people who are managing different portfolios. Maybe,
Everyone was doing something. I'm the only one
yeah,
doing what I did. No one did
okay.
what I did.
But you also are in this position where, as an option trader, I find myself also like aware of everything going on around me. I'm thinking of the environment. People are quitting their jobs to be full-time traders during the dot-com bubble. We ended up seeing the same thing occur back in 2020 as well. And
Sure.
then, there's just everything's going sky high, and you're just kind of ignoring all that and just running your strategy as you always would. Is that kind of
Yeah,
right?
that's
Was there,
correct. Typically in this strategy, other than bear market cycles, you can see returns anywhere from low 20s to in excess of 40%. So if the market's just staying in a nice channel through a 12-month cycle where it's not moving much more than 5 or 6% swings at best, you're just printing money at that point through the strategy.
wow.
And that's even in a declining market. If the market's declining 5-6%, each cycle, each short-term cycle being like a 30-day window or less, you're surviving because you're traditionally, when you play this strategy, I should have done this in the beginning, I'm sorry. You set your top and a bottom. On the bottom, you're working at around 10% below the market. 10% drops in 30-day cycles are fairly rare. They only come once, at most twice a year, at most typically. And those, if they are not a full scale bear market being 20%, then they're pretty maneuverable still at that point. So lower vol, you want really, I shouldn't say lower vol, because then there's no premium in the trades at that point. You want medium vol. It's exactly that's the best recipe to print some money. And then you're right on every side of your trades, tops and bottoms, and you're just collecting premium.
So
As
while you
the
were doing this, or sorry, while you were doing this, like during the dot-com bubble, so when I was working for an RIA a couple years ago during COVID, we had clients left and right calling in, why aren't you buying GameStop, or what were the other ones? Not AMD, AMC, or any of those, high grower garbage can stocks. Like, were you ever called or asked to look at those while managing other people's money, or was that just, or was it under the understanding that this is the strategy I'm going to do, this is what I'm going to stick to, this is what you have asked me to stay with
So,
during this period?
so, so it depended on the account. So basically, the majority of my clients were working with me for the option strategy. So we had allocated funds to the option strategy. Anything in excess of that, we would typically do long-term core investing. I didn't really have enough time to pick the highest speculative individual stock while I'm already leveraged at close to 10 to 1 on naked options that have a theoretical loss of infinity. So the answer to that is I always had enough knowledge to tell my clients typically these are just going to the casino and you pick where if you spin on the wheel and win, take your money and run. That would be my experience with some of these lower quality names. It's just hard to make any evaluation. There's no fundamentals to make your basis. Now, if you're excellent enough trader and cut your losses short, you can figure short-term trends in these names and make some money.
But you have to be so good though. I know people who are even good that still those just end up being big winners for them and they'll never touch them again. I never touched the meme stocks.
Yeah, they're too
because of
hard. I've
yeah.
yeah. I saw
Here,
Enron, even names that looked legitimate. Enron being one, right? That was a huge bubble. It blew
oh
up,
yeah.
nothing left. Yep. And that was one that you thought was good. Correct.
Right. Yeah, and that was I don't know what that option chain looked like, but even if you're trying to play the upside, or if you're trying to short it on the way down, if you're on the buy side, it can still be nearly impossible. Like
Oh,
even yeah,
even though the stock's going down, the rips to the upside can still be percentage wise north of 10-15%. And if you're short, hopefully you've already taken that loss before it gets to the end of that rip, because
yeah,
you'll be sweating it after that when you're in the hole 15% and the trade's not done.
yeah. No, and it can happen fast in a blink of an eye for short term. Yeah, that's brutal. I so what I am so curious on as well though. Do you feel like during these time periods, the dot-com bubble, did you anticipate that being a bubble at the time? Because here's my
Oh,
thought. Here's the
we all knew it was a bubble. It was just a
yeah,
matter of when. And at that time, if you added a .com to your name, automatic 10-15% bump.
right,
No
right.
joke. I never saw anything like it before. I'm like, this
It's like
company's not even involved in .com, and they add in .com.
Yeah.
It
it's like
was
in China, semiconductors and EVs, like
well, we
it
knew
was the
it was
thing.
like the tulips in Holland in the
Oh
day,
yeah.
right? With the tulip mania and stuff like that. It just, you don't know how far it can go. You can't short against stuff like that because it's just too dangerous. You will be right, but
You'll take
unless you
Who's
are
gonna buy it?
yeah, if you're a very wealthy investor, you have the staying power. Otherwise, the average person does not.
right. And
I'd
even when it
imagine for a run up and a rundown like that though, finding a counterparty when it's it's a bankrupt
When you're
company or just going to zero, like who's gonna buy back or borrow or whatever. Like that's a lot of
yeah,
risk to find a counterparty.
Yep,
yeah.
that's correct.
So were you ever tempted though? Let's say when it starts to crack, you see the trend developing. Was there ever the temptation to well actually before I ask that, was this a did you have a prospectus and everything that you had to follow this strategy and you couldn't deviate from it? Built into the or what was the construction of this like for within the company? Or
No,
was it
so I devised the strategy. I never got it officially into the fold of the firm, which I was
okay.
working on doing, which would have gotten me. I still had to call clients for trades, but I would call early in the morning for my morning trades as we would trade into the opening rotation.
Okay.
Um, so I did not manage a lot of accounts. They were just big accounts.
Oh, so you knew your client. Yeah. So that's also how
They were
you
all accredited investors. You can't do this
yeah,
strategy unless you're
right.
accredited. Most
And
firms won't let you.
and you also did this for decades, so you knew them for like
Correct.
extremely close. If you're calling them for every trade, that's a
Correct.
lot of conversations. That's a lot of touching
Uh,
points.
when we're in volatility, it would not be unusual to speak to a client a dozen times in a couple of day period or whatever.
Yeah. Okay. Wow. Wow. That's that is a whole other level of emotions added to the game when people are also questioning you and your thesis and your convictions. It's one thing to be trading in a bubble of silence on your own and something goes against you and you're like, oh, it'll be fine. But if I had someone in my ear or someone calling me like, hey, what's going on? Boy, that could be
Uh,
how did just
so it would be rare, but
yeah.
you would sometimes get a client they couldn't take it anymore. You could sense it, and the worst thing you can do is hold them in and be wrong, more wrong than what you were already wrong.
Yeah.
So occasionally you would give the same story to everybody that look, we've done the strategy for decades now. Prior to us, this was a award Nobel Prize winning strategy, Black Scholes. That is what the strategy is based off of. It's mathematically proven to work. The difference is mathematically the strategy works, but the problem is you have to have such deep pockets to sustain that only the top 1% are people like up there that have millions and maybe hundreds of millions can survive that kind of volatility with funneling more money or meeting margin calls.
Yeah. Okay. My word. But they were, I mean, I guess over time they actually became, was it
So what
for,
would happen? They would learn that they had to stick it out during the volatile times, push out the strategy like I mentioned, and wait for the market to come back in line. 95% of the clients followed those instructions. The ones who didn't took their loss then and there and moved on.
okay. All
And
right.
then they may have stayed with me for regular stuff if they wanted to, if the relationship was strong enough. A couple of them would just say, I can't do the options, Matt. I want to still stay with you, but I can't do the options.
Okay. Yeah. Yeah. Cause a lot of people are not very, this a very rare individual to one, have a huge accumulation of wealth, but then have the risk tolerance to be able to enact that. And was there any of them that were just like, just, I don't even want to look at it. Just do your thing. There had to be a
Yeah,
few of those, right? Like
yep,
this,
there were.
I could do this if I never see it.
Yes, this is correct.
Yeah. Yeah.
Just send me the
Okay.
quarterlies and we're
Yeah,
good.
that's what they wanted. They're like, let me
Yeah.
know
Yeah.
quarterly how we're doing.
Yeah. Okay. So yeah, that's a whole other thing. I just imagining that process. So um I guess we should uh kind of get into the uh meat of what like what was different. I guess the rapid pace at which COVID happened. Oh well, no wait. Let me backtrack real quick. When you see the turning point in the markets and new trends develop, because you're talking about your best scenario is a mostly flat market trading within probably a very predictable range or a slight downside where I imagine you could then profit off of the changes in volatility. But when we're talking about, during the run up of the dot-com bubble, or even seeing the massive downside of when everything's crashing, is there any part of you during those periods where like, man, I wonder if I should just kind of go long on some puts here or go long on some calls here and kind of switch it up? Or did you never have that temptation? Because that would be such a strong temptation for me to be like, I
Um,
see.
I always stuck to the strategy during the
Yeah.
point of I didn't switch to going long and short or long the put or call.
Okay.
Because first of all, if you do that in the trade, you're going to be completely right or completely wrong. There's no
Yeah.
in between. So you're either going to look if you make that call to a client and you're already getting roughed up a little bit. And now you're going to jump to one side or the other. Um, it can just double up your losses real quick.
Right.
If you're right, you make the loss right back. But
But you were playing
as
along.
we all know, it's difficult to know that your trade's going to work till you can do all your homework and do everything that you implied to do, but it doesn't mean the strategy works or that the thought turned out to be correct.
Right. Well, yeah. Well, yeah, that's true. Yeah, there's plenty of times where you even have a thesis that's correct and there's just no opportunity on the option chain. It's just not
Yep.
there. It's already priced out.
Or
So
no one else sees it that way.
Yep.
yeah, yeah. Oh yeah. Yeah, the market can be irrational longer than you could be solvent,
Yep.
especially in options. So when we're talking about what happened during COVID and that crash and these clients that you've had for a long time, and like just walk us through what that experience was like, how you felt,
Well, that was
after all these years of bouncing
so
back
that
from
was
these pretty catastrophic things. Yeah.
yeah, so that was the toughest period of my life. I had to make some nasty phone calls to clients. We had all been through rough periods before, but this one was definitely different. Um, the drop in the Russell 2000, which was the index that I traded, was 40%, and it was either 5 or 6 weeks. So, and then if you guys don't remember, the market recovered everything in the next 90 days and then some, set all-time highs. So it was a big black swan, is what I like to call it. It's something that's unforeseen. No one knew that COVID was going to come around, and no one knew that COVID would cause as much of a scare. Because if you really look at it, we have more people that pass from the flu each year by a large number than whatever were dying from COVID in the highest point. So you didn't know. We were told different things from doctors. I was more in the camp that it wasn't going to be as bad as the market was predicting. That was a mistake that I was wrong on. I saw that when the market just continued to come in, and even before the bottom was set, you knew the bottom was coming, but the market just could not get any firm footing. And the bottom day was when that when the S&P was down 1,000 points. I know I was shaking in my boots around that time. I'd never seen 1,000 points come off of the index. Those were just like those were hurricane-sized swells that were happening in the market. If you were fortunate enough to be liquid, there were some true opportunities out there at that time because everything was just being taken down at once. It was fear. Fear is the uh, biggest factor in the market, are the biggest motivator mover. Fear is much stronger than greed. Greed sends stocks higher, but fear just has them collapse. And the
Yeah.
collapse is immediate, where the greed is usually over some time.
Yeah. I
Yeah, I
mean,
was thinking about that today, how
that
fear creates irrational decision making,
The most,
and that can be dangerous.
it's also a huge,
very.
it's also a huge selling point, though. I see this all the time on. This doesn't really apply to you, Matt, but all across the socials, there's lots of fund managers that will only post bearish content. Meanwhile, all their portfolios are long, but they know what really catches the people's attention and what makes good advertising is constantly
Sure.
focused on this potential fear or that potential fear and be worried about this and it's
Well,
the
here's
Liz.
an important lesson for everyone too. If
Yeah.
70% of the time the market goes up,
Yeah.
so remember how the market actually does very well against negative headlines. It can just grind higher and grind higher. And most of the time, the disbelievers of the market going higher get crushed. You can't if the trend is still showing higher, even with the negative news coming. We're not talking when the market's overexpanded on a price multiple basis or some of the fundamental analysis. You just have to let it play out, because we saw the big fear last year with the recession. Recession didn't show itself, and the market's done fairly well since then.
Yeah.
But if you remember, about a year ago, everyone was doom and gloom and run for the hills kind of thing. It
Yeah.
always comes.
So I was actually because we've talked before doing this podcast. I've talked to you on the phone a few times. I was under the impression that you didn't have a really a close eye on the market. but you've said a
No,
few things that are making me think that you do kind of have a close eye on the market. You're
no,
still
you have
active.
to.
Yeah,
Well, remember, you're trading an index if you're doing this strategy, so you have to have a good grasp of what's going on in the market. You got to
yeah,
know both economically, as well as certain, like, you need to know when Nvidia is going to report earnings because it's a market mover, not just for itself. It's going to be up tomorrow, but I suspect most tech stocks are going to have a good day tomorrow.
yeah,
So you do need to have a grasp of all that because those are the short term, real short term bumps that are going to come potentially in the road for you. So you do want to have you need to have a handle on that. Otherwise, you're flying blind.
so you are still actively today running this strategy then?
No,
No. Okay. All right. I was just
not
very
with the way
curious about
things
that.
ended. No.
Yeah. Well, so that I really want. I really just want to double click on that. You beat the market for 20 years. Is that right?
Yep. Yep.
You beat the market for 20 years. You have basically the market can have those downturns, like you said, every 7, 8 years. But COVID was maybe once in a lifetime thing that happens. Is there any part of you that would come back even on your own personal account
Well,
and come back?
first I got to build some wealth up again.
Oh yeah, yeah. True.
Number
Yeah.
one.
Yeah. 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 So if you did,
But I had some clients that still had big accounts. You never want to put all your money into one strategy, because if you're wrong, you lose the house, and
yeah,
that never makes sense. So whatever your best forte, your best strategy is, you should probably never keep more than around half, something like that, and then keep the rest of it into a strong foundation so that, God forbid, even if you blow everything else up, you still have half of it in something that you don't have to watch. You want it in something you don't need to watch daily because you're
yes,
going to be too involved with your other stuff. You can't worry about that while you have a hot fire over here.
right. Now, did you do that? You also had
Yeah.
your own long-term account while you're trading your option strategy.
That's what that's what I've been living off while I'm trying to rebuild myself. Yes.
Okay. Oh wow. Okay. Yeah. My
I was
gosh.
making the kind of money I was making before is nowhere near what I'm making now.
Yeah.
What do you buy for your long term strategy? Are you buying more, a balanced portfolio or?
So typically I like growth still. You guys are younger than me, so growth over the long term outperforms. So you don't have to have hyper growth or any of the, that kind of growth, but like S&P strong steady growth is perfect. I have no problem buying S&Ps, and then you just have money when the big storm comes, that 20% drop, the first thing you got to do is start getting more money in the market
Yeah.
on the
Oh, absolutely.
S&Ps.
Wait.
Not
So
on not on your not on short-term trading strategies, but you want to have excess to funnel in at those times. And then you just forget about it and let it work. You guys, the general rule set for long term, it's 7 years for a full market cycle. So if you can sustain 7 years, even if you invest it right before COVID, well, COVID was so fast and recovered, but right before the housing bubble, which took quite a while to recover, even if you invested right at the peak, 7 years later, you were at least back to even or growing again way before that. So
yeah.
Absolutely. I was brought into this world on in a value shop, so
yeah, so
breaking
you know
into
that.
that
You
growth
should still
side.
keep those principles in. I
Hmm.
think those are great. I love trading. There's nothing wrong with trading, but you don't do 100% of trading.
No, no,
I
my growth value play was midstreams during COVID, and there were some that did phenomenal. There were some that are still yet to recover, but it's that was my growth value play midstream
Yeah.
as well as E&Ps.
Yeah.
so let me ask you something then about this current market. When you're so you don't have any is there a way of oh I let me backtrack. I'm interrupting myself too many times. When you're when you're managing that long-term portfolio, how active are you in that?
Try to be as little active as possible other than adding positions.
Okay, absolutely. So was there any time periods where
Never
you're
try to
like,
time the market with those assets. Never, ever. Because those are your core positions. If you have, we just went over 7 year cycle. If you have more than 7 years before you expect to use the money, you have a good faith of knowing that likely the market's going to be much higher, at least the same, if not much higher.
right, right. And those majority of those for you, do you do individual stock picking in your own long-term
I
management?
did, but stock picking comes with a mixed bag, is what I would say with that. What the the area that you can do potentially the best if you can find long-term growth stocks fairly early. Um, you can make a lot of money. Nvidia was not that was pretty, or was it? It was around $100 when I bought some Nvidia about 5 years ago or whatever. So that one's gone parabolic or whatever. But if you can find names like that and hold on to them, don't trade them, you'll make a fortune.
Yeah, yeah. I have a lot of members that I gave my buy signal on NVIDIA in 2020 was the last one I gave.
Yep.
Yeah, at 125. And it's been crazy. It's very
Yep.
tempting. Yeah. So, and I've actually been looking, talking to many members about thinking about selling some calls, doing covered call strategies with those.
Sure. Cover
Uh,
call strategies are great.
yeah. With around these levels. But let me ask you, since you're kind of watching this market right now, the big game that a lot of that I like to play is how many times am I going to hear the word AI in this earnings call that I'm about to listen to? Do you feel like there's any similarities
Sure.
between
To that and the
this?
.com.
Yeah,
Of course, in certain segments, the stocks have gone extreme extreme valuations of which they may never be able to generate revenue to what the current market cap has expanded to.
yeah. So when do you think Nvidia is a symptom of that?
They're one of the cutting edge companies in there. So I would equate more Nvidia to being like I mean they're not fair comparisons in the in the same industry, but like a Microsoft, like a Google. They're likely to be, unless someone can come in with technology significantly superior, they are the leader in a cutting edge technology that's going to change our lives over the next decade.
Right,
Even if
If
so, they're already scaled.
they stay at the front of the curve, you buy it on dips then.
right.
You don't want to buy it when it's expanding, but you buy it on any kind of extreme market condition. Market's down 20%. You see if that stock has been roughed up during that period, that's your entry point.
Right. No, I had the same opinion. There's a lot of people worried about this earnings. And my opinion was like, if we saw a big dip this afternoon post earnings, I think there's
A
so much
trading
money.
opportunity for a
Right.
bounce. Yeah,
Right. There's so much money on the sidelines that would love to buy this thing on any significant dip that comes in. Uh, especially an election year. I have a very
so
bullish
remember,
bias.
naked puts are a good way to enter into a stock.
Oh yeah. Then like execute, buy deep in the
Yeah,
money
because
and
you can make
execute. Yeah.
if you never get your stock, you're making money along the way. You're collecting your stubs every time. And if you're
Right.
putting a strike at a level of what you're willing to buy it anyway, why not? You know, because a lot of times the stocks never come to the exact point that you want to buy them at. So if you place something that's 10, 15% below and you can still get paid, you do it.
Yeah. That's exactly what I did with Tesla today, where I was expecting. I bought some initially after earnings. And I'm like, oh, this looks like a great opportunity. It's crashing. I then did my technical analysis and I was like, I got a little worried that I had maybe FOMO'd a little too much into it. So I let it kind of settle. It looks like it's confirming back into a bullish trend, actually running
Good.
opposed to the market right now. And I was like, okay, I'm up on my initial position, but it isn't as what I want it to be for the stock. I think
Well, we also know
yeah.
what you're seeing in after hours trading is
So
not always how they open the next morning.
oh yeah. Oh, exactly. Exactly. For all these names. But that's what I did with Tesla though. I decided I'm gonna buy some. I bought some June contracts calls in the money. And if it performs like my thesis, I'll just go ahead and
Take
snag
the
those,
game.
keep them. Yeah.
Yep.
Yeah. Yeah. Capture that. That's a great strategy. I don't think enough people do that whatsoever at all. It's because it's a great way to do that. So let me ask you about the let's backtrack a little bit, talk about the um when you walked away from the business. Is that and now we've heard stories about people who blow up and end up getting back into it, say they learned their lessons. Do you think you could have gotten another job at another firm doing the same thing, or was this just the nail in the coffin for you? Felt like, do you feel like you'll ever return to the business? Because the 20-year track record of beating the market, despite what happened, you're in a very small group of people with that skill set.
It was very stressful when I did it for the years that I did it, because you're handling. I don't mind losing my money, but I do not like losing clients' money. That's just me personally. Some people handle it better, but having to make those calls to clients to let them know where some of the people had very deep pockets, and that none of my clients had money that they shouldn't have in it, but some of them it was half of what we were managing. So we had half in the options, half in long-term core. So, but calling someone to tell them you've lost almost half your portfolio, not an easy call. And then you have to kind of sense what the client he's going to say after that. Because what are you going to say? All you can say is you're sorry. There's nothing else you can say. So um, when you lose people money, people change. I will tell you that.
Mhm.
Oh yeah. Oh yeah.
And especially if it's large money.
I believe it. So you've, I mean, a lot of those people were your friends and everything, and at
Yes.
that point, when you know them, when you know someone for so long, you probably know their
Yes.
families even. Yeah.
Yep.
Yep.
It just makes it hard. I wasn't, I still have kept my licenses active, but I'll have another couple years. And after that, if I don't get my license into another brokerage firm, then they will expire.
Yeah. So do
And
you?
I have probably 10 licenses, commodities, options, manager's license. I've got supervisor license. I got my series 65, 66, 9, 10, all these licenses. It's frustrating. I put a lot of time, effort, and energy into being on Wall Street my whole career, and then to see it all blow up in a 2 month period.
Mhm.
Is yeah. It's actually really hard to put myself in your shoes to even probably understand the
A lot of
yeah,
sleepless nights, I could
yeah.
tell you that. And you're
My
up at like five
word.
in the morning.
Yes. Holy cow. And I and I know in my early days of trading, I blown up accounts. And that's not even close to probably yeah, not even comparable to losing the people's money. So all right, so you've been trying to get back into the industry though, and having
I haven't made any discussions. I had a couple
okay.
recruiters call, but um, but I told them call me. I always just tell them call me in 9 months or whatever. I'm not
Okay.
ready to make the decision myself yet to come back in. Um, it's a very specific kind of client I'm looking for. So it's I had finally built enough critical mass and had enough clients that I was getting a referral. You only need to gain 4 or 5 clients a year with this kind of strategy, because you're handling such large amounts of assets. So
Yeah. When you're I should ask, when you have them in that strategy, they're making 20% a year. Are they just putting all that money back into the fund? Or were they
it
taking some of
depends on
that?
the individual. We
Okay.
had a
Okay.
couple people that were like, I had a business partner. He did more model portfolios and stuff like that. So the option grew enough, the option side of the portfolio, he would siphon money back into the other sides where the money, so he stayed in line with his portfolio mixes.
Okay. Okay. That's good. But personally, when I make these big wins on my options in my trading portfolio, I usually transfer some of that money over to my long term. Is the way I
Yeah,
handle it. Yeah,
that's the way to do
yeah,
it. Yes.
yeah. I think that's the best way
I
to do.
highly recommend it. That's how you'll have longevity in the market.
Yeah, yeah. Well, I mean, even I think that's always an interesting conversation, though, too, because I think one of the best things that you've kind of said, but not said, implied, is that trading options is not it might be short term in the transaction of one trade you make, but the greater returns is actually the repetitiveness and the accumulation of all the probabilities played out over a longer time frame that actually show the worthiness of the strategy that you're using. I think what's really interesting about the way you traded that and that strategy in particular, in my experience as an options trader who's often naked long or running credit spreads or similar strategies, I don't think of it as a science. I think of it more as like an art. And
That's
because
100% correct.
yeah, so you still even thought about it that way, even running the type of
You have to,
strategy.
because if
Yeah,
you run it just straight discipline, you got to have a mix in there to handle what's going on in the market. So, yes, maybe all your indicators are like get out, get out, get out, but you realize that the market's already dropped 20%. Once the market drops 20%, you are typically 90% through any type of downside cycle. A
yeah.
lot of fear, and everything you're going to read at that time is things are terrible. The recession's going to be so deep, this, that, the other, and then they never play out like that, and the market does its recovery.
Yes. Yes. In that case,
So
yeah,
it you're painting a portrait. Think of it like that.
right. No, I agree with that. Yeah, and you're like, I've got to see it kind of playing off the sentiments of even just Warren Buffett's age-old quote, like it would be fearful when other people are greedy, be greedy when other
Sure.
people are fearful, kind of always be playing against the crowd, which is why also I'm so impressed by your ability for as many years as you did to maintain your mental when there it's one thing when I read something on Twitter or someone posts a comment on a video I've made and they say something, I'm just like whatever. Because the sentiment the interesting thing as someone who creates content and you might have a different variation of experience with this is oftentimes people don't agree with my ideas. I have a really good accuracy with being correct, but usually everyone thinks it's dumb. And that's
That's
why there's
usually
an
the sign.
opportunity. Yeah.
That's the sign of a good trade.
Yeah, exactly.
When no one
That's
else likes it, that's when they always work. When they all like it,
yeah,
be
that's when you get
careful.
worried.
Yes,
Yeah. Yeah, that's when you
it's
get
true.
worried. It
It is
really
true,
is.
though. Yep.
That's funny. All right. Well, this has been an absolutely awesome conversation, Matt. I really appreciate you.
My pleasure,
Like,
guys. I hope that
yeah,
was helpful.
it really was. And just tell your
Very
story
insightful.
Good.
extremely. Um, well, I really appreciate you coming on here because it's probably not it's still not easy to talk about that and that experience. And I would also I'm rooting for you. I want you to know that. I'm rooting for
Thank
you.
you.
Yeah. Because even though you had this period, like what you did for as many years as you did it, and the skill you had, that's such a skill set. It never goes away once you build that. So
No,
yeah. So I appreciate your time, Matt. I think we'll go ahead and call it. Monty, do you have any last comments that you want to mention? Um,
Yeah, and I know you're gonna glare at me for saying this, but it's not about falling off the horse. It's about how you get up and recover,
sure.
and you going through like literally catastrophic event after catastrophic event across a multiple decade career. I mean, even if this is just a blip, when you look back in hindsight, you're gonna say, "Wow, I overcame this, got back on my feet, and I'm sprinting now instead of going for a light jog." So I think it's just gonna be a blip, but
Let's hope.
um, let's hope.
yeah, yeah.
Excuse me,
All right,
but yeah, I
gentlemen.
appreciate you coming on.
Really
My
appreciate. Yeah.
pleasure.
And for the podcast listeners, make sure you check out the links down below. check out.
Send me the link so I'll know where to watch it or hear it.
Yeah, absolutely. We'll send you the YouTube link, and then yeah, for the listeners and viewers on this as well, make sure you check out Monty's Substack at the Peach Pit for all his research that he puts out for everyone. And you can, of course, find me
Thank you,
in the
guys.
description down below. Yep, absolutely. Thank you so much, Matt. Really appreciate your
Thank
time.
you.
Have a great day, guys.
Have a great
You
day,
take
man.
care.